President Trump, enough about me. Now you talk about it. Confirming he has no plans to fire Fed Chair Jay Powell, downplaying earlier reports that suggested otherwise. Joining us now with the latest on this story and what firing Powell could mean for the markets. Nick Timiraos, Wall Street Journal chief economics correspondent. Earlier, Nick, we were...
Fed whisperer.
He is. He's got... If you read it from him, you probably can trust what he's saying. But my point earlier was, have you ever heard anyone argue that the Fed doesn't need to be independent? No one seriously that has any sense of history would say that, because we know what happens when you keep rates too low. You turn into South America, or a country in South America.
Well, Joe, thanks for having me. I mean, this is not about buildings, right? We're talking about these building renovations, and you're right. This is about whether this institutional arrangement we've had in this country is going to continue. There's no law that says the Fed is protected in this way. We don't even know how a court would rule. So this is about the administration trying to put more pressure on the Fed and really win, not in a court of law, but in a court of public opinion. And buildings are salient. I mean, it's something I think it's breaking through. Everybody understands it. I get text messages saying, is the Fed really doing this? How did this happen? It reminds me in the 1970s, there were, false stories planted about the Fed chair, Arthur Burns, by operatives of Richard Nixon to put pressure on him. They said he was seeking a pay increase at a time that the Fed was proposing income and wage and price control.
And that's why Arthur Burns caved.
They put pressure on him. I mean, they were pushing on an open door, I think, with Burns, and I'm not sure that's the case here with Powell.
Right.
But so this is really about just a maximum pressure campaign. Maybe it gives them a pretext to try to remove him if that's something the president wants to do.
Right.
But I'm exhausted just following back and forth.
The other example is the first Bush, who blamed Greenspan for losing it. But then whenever we talk about this and people go back historically, prior to the Nixon thing, there were some other really solid examples of unbelievable pressure from the executive branch on Fed chairs in the past. It's happened again and again. Is this the worst you think it's been, or sort of par for the course?
It's the worst in our kind of modern experience. I think the other point here is that we are going to have the most unusual Fed transition ever, since at least the Volcker one, because in '87, Volcker to Greenspan, in '06, when Bernanke came in, Yellen in 2014, Powell, they all pledged continuity with their predecessor. They said, I'm going to step into the shoes of my predecessor. I'm going to try to be the same Fed. And now we have people who are running for the job who are saying, I'm going to be completely different. And so it's going to be a very unusual transition, even if it happens on the normal May 2026.
Right. So what do you make of the argument that actually the independence of the Fed is already over? I mean, that the market already recognizes that Jay Powell won't be in that position. It's unclear who will be, but whoever will be will have made some kind of blood pledge to the White House to lower rates by default. And by the way, whether they have or haven't almost doesn't matter, because the perception is and will be that that's the case.
Well, so it's obviously what the president's doing here is putting the next Fed chair in a very difficult position, right? They're going to have to prove to the market that they're not what everybody thinks they are. But you still have 11 other people who are going to vote on monetary policy. So I think the risk here is that, Jeb Bush said you have to lose the primary to win the general. You may have to win the chair and lose the committee, and you become a chair in name only if you push this too hard. So I think that's the risk here. And a lot of the things I was hearing a decade ago when I started covering the Fed, Taylor rules, we need to get rid of discretion, low rates are bad for savers, and now you have a president demanding, negative real interest rates. And so it's just, it's a remarkable situation, the switch, the back and forth that you're seeing here.
And the big transition you're talking about, biggest ever, is the guy that's picking the new Fed head is the same guy who picked the last one that we're having the big transition from. So it's the same president is going 180.
But Andrew, to your point, I mean, people saying the Fed has already lost their independence, I don't hear that. I mean, you don't see the reaction yet in the bond market that would suggest
we can't run a Fed that way.
But let's just play it out. Play it out. And I bet you the president
is going to be like Mayor Adams.
Well, no. Let's just play it out, though. In the following, maybe that's actually a good way to think about it. I don't know. If, in fact, tomorrow the president were to announce that he was firing Jay Powell for cause, because he believes that he had found some something in the way the building is being created, whatever. And it's, even if it's all totally made up, let's just, I don't know made up or not, but let's just say that's what happens. What happens in the bond market that day?
And with the dollar.
Right. You know, they have to announce who's the new king going to be. So they'll have to put that out. The market will have to assess. I mean, I think it's very unlikely Powell would go in that situation. All of his body language. I mean, go back.
Right. No, I understand that. But let's say we got the picture of Kevin Warsh here on the screen. Let's say they announce Kevin Warsh is getting put into this spot. Jay Powell is going to be fired. Jay Powell says, I'm not going to be fired. I am going to go to court over this. The bond market reacts. And by the way, if they actually think that for some reason Kevin Warsh, if you think he's going to lower interest rates, or whoever it is getting in this role, like, what do we actually think happens? Because I think in truth, and this is the interesting part about President Trump, I think he thinks to himself, play that whole thing out. Does the bond market decide, like,
and was yesterday an interesting test?
Yeah, we're just not doing this.
I think we don't know. I mean, I talked to someone yesterday who said the danger here for people who believe in the Fed independence is that the market actually doesn't react all that much, that it reacts over time. You get into some situation where the Fed needs to do the unpopular thing, and that's when you see the long end sell-off. But the danger here is that, you know, as with everybody saying, oh, we're going to have all this tariff inflation, and then you don't see it as the CPI. Same thing here. What if the bond market doesn't?
Well, and that's where I think President Trump actually is.
And that's the guardrail.
He sees through a lot of these kind of things too.
Look at the candidates that are there. The two Kevins, Scott Bessent, Waller, whoever the candidates may be. Is there an Arthur Burns among them?
Not for me to say. I mean, it's awfully hard to tell how the next chair is going to step into this position.
It actually is for you to say, by the way, since you're the guest.
No, I'm not the opinion guy of the Journal. I don't work for the opinion page. It's hard to say. I mean, what does the economy look like in the second quarter next year? I mean, maybe by then, what if we've got into a downturn and the Fed has had to cut? It's very hard to game these things out.
I mean, that's what Bank of America was saying yesterday. Brian Moynihan, when he was on, was saying, look, we believe in the independence of the Fed. Their own internal expectations at the Bank of America is you're not going to see a lot of cuts until the second half of next year, which would be when the new Fed president's there anyway, Fed chairman's there anyway. Then they're expecting 100 basis points of cuts at that point. Yeah,
you see some of that priced into the market right now, but you know, these arguments around
just that the economy would then be arguing for rate cuts.
Well, there's some people who think, you know, June next year, maybe the new chair comes in and tries to provide some additional restraint.
Yeah. I mean, Nick, if you don't have someone who's willing to act on experience or intuition or to try to look around corners, you might as well have the Taylor rule. If all you're going to do is wait for data to tell you what to do, you're never going to be ahead of it, and you're probably going to be behind like they were a couple of years ago when inflation was going to run hot. Now they could be behind in trying to get ahead of an economic slowdown. They may be behind again.
Well, you're absolutely right, but let's not ignore the tariffs here, putting them in a difficult position after we've had 4 years above the target. So there's some worry here. You know, are you going to see the second round effects?
But your paper, every time they talk about inflation, they say it's not from tariffs. It's from too many dollars chasing too few goods. They always say it can be a price increase, but not the second derivative.
I think that's the challenge here for the administration in arguing for cuts. The most persuasive arguments that I'm hearing for rate cuts right now is that tariffs are going to destroy demand. So the consumer is not going to be able to accept higher prices. Companies are going to have to compete. They're going to lose market share. You know, everybody's paying attention to goods, inflation and goods. Well, what about services? Let's watch services over the next couple of months, because if this is going to get passed through, if it's a relative price adjustment, then services is going to continue to disinflate, and that'll take some of the edge off here. Exactly. But they can't make the argument that our policies are going to weaken the economy, so you need to cut interest rates.
Is there anyone in the world that could do the right thing a year before it happens?
You know, it'll be obvious in hindsight.
If you wait to see the whites of their eyes, you're definitely going to be behind the curve, almost every time.
This is all about making the mistake that's easier to fix, right? That's one way to think about risk management. Are you going to get off sides? If you think you're going to get off sides, you just want to make sure that You don't have to jump too far
That is
back.
very good.
That's just like golf. If your
Play it
worst
safe.
thing you do, you don't reach a green, but you keep it in the fairway instead of
You
But
want
you
to
don't put
avoid,
5 in the water.
Yeah.
Trying to
Rob
strip across.
Kaplan made the point to me, you want to avoid mistakes that take a year to fix.
Right.
If it takes a couple of meetings to catch up, you have to cut a little bit more, okay.
Right.
But if you're offsides and it takes you a year or 2 years to get back on sides, that's what you're trying to avoid here.
So we don't
what's
want
the,
predictive behavior.
What's the mistake that's easier to fix?
Yeah.
Right.